afternoon, and thank you for joining us for the Executives Club of Chicago 5th Annual VC Outlook, Future Funded Inside the Next Wave of Venture Capital. For those of you I haven't met yet, I'm Dory McWhorter, and I have the pleasure of serving as President and CEO of the Executives Club. I also have the pleasure of welcoming all of you and our expert speakers for this afternoon's conversation about the current VC landscape, investment strategies and risks, and the future of the startup ecosystem. As market pressure, tech shifts, and evolving expectations upend the old playbook, the investors who are writing the checks are also rewriting the rules. Money may be moving differently these days, but it is still moving. To share their insights and provide their frontline perspectives, we are joined today by Such Chitnis, co-founder of Jump Capital, Mar Hershenson, co-founder and managing partner at Pear Ventures, Jay Dawes, president and partner at Sapphire Ventures, and our favorite moderator, Professor Steve Kaplan, the Neubauer Family Distinguished Service Professor of Entrepreneurship and Finance at the University of Chicago's Booth School of Business. Following the discussion, please don't forget to share your feedback. You'll receive a survey by email, and you can always reach out to us at ideas@executivesclub.org. And in case I don't connect with you before then, I hope everyone has a joyous and delicious Thanksgiving holiday. So now I'll turn it over to Professor Kaplan.
Great. Thank you, Dory. It's a pleasure to do this for the 5th time, and it is awesome to have Mar, Jay, and Such here. So what we're going to do is what we usually do. I'll begin by providing some macro thoughts and stats about tech and venture, and then we'll move on to the micro and Q&A from our panelists. So let me share my screen, and here we go. So where are we now? So 4 years ago, we were in the golden age of VC. Then, like 3 years ago, it was sort of the end of the golden age. And last year, Ivy League endowments were were struggling. This year, you've got a funding surge in AI. Now it's a bubble. So it's been up and down, and it's kind of all over the place. Now here, if the bubble bursts, which it didn't clearly do, or it's sort of been doing, but maybe not, we will see. So it's a period of a lot of uncertainty, and it'll be really interesting to hear what our panelists have to say. So let me just give you a few stats about where we are now. First of all, what happened in the last year, and this is through Friday, you saw that technology stocks have actually been up by more than anything else. NASDAQ up a little bit less. The S&P has been up almost 14%, and the Russell, which doesn't have big tech, is way behind. Bitcoin this year was up only 1%. So that's different from previous years. We can go back 5 years and see what's happened over the last 5 years. And technology, again, has been a very good performer. NASDAQ second, S&P third, and Russell last. So that sort of mirrors what's happened this year. Bitcoin, however, is still astonishing, 12 times since the beginning of 2020. So if you were in Bitcoin early, that was a good place to be. How about venture capital? What's here is the IRRs per fund by vintage year. So the black is the average venture fund, the red is the median, and you can see that funds raised after the GFC did very well, 20% IRRs on average, 15% median, and the IRR is the annualized rate of return. But the vintages 2019 and after are not performing as well. And you can look at this as a multiple of invested capital, which would be your cash on cash, and that kind of looks the same post GFC, 2.5 to 4 times average, and then coming down as we get to more recent vintages. And then if you want to compare this to the S&P 500, you can see that the average fund was beating the S&P 500, the median fund somewhat. This is if it's above 1, it's beating the S&P 500. The vintages since 2018 have not been beating the S&P 500. So this is, again, if you put your money into the average venture fund or the median venture fund, it was really good from 2009 to 2018, and it's been a little bit more challenging since then. So, and this just annualizes that. So showing your annualized return, this is kind of a cumulative measure. But the bottom line is, the vintages really since, 2018 have been challenged. Now, let's take a look at how it's moved. The red is where the performance was in 2019. And then it popped up in 2022 when we had that golden era. And now it's popped back down to where it was in 2019. So still outperformance, but not as big an outperformance as it had been. So that's on the return side. How about investment? What are VCs doing on investment? And this year has been a pretty healthy deal. The 2025 numbers are through Q3, and the investments in companies are actually higher in 9 months than in all of 2024, and really higher than in any year except for 2021. So lots of VC investing, and I believe a lot of that is AI. More and more in larger deals. So the green is the percentage of smaller deals less than $1 million, then 1 to 5, and then bigger deals. So fewer smaller deals, more bigger deals. And this is exit. This is getting your money out. And this is, again, why part of the reason the returns are a little challenged is exits, while they're going to be higher than they've been in 22 to 24. Remember, 2025 is just the first 9 months or 3 quarters. It's still much lower than we saw really in 2019 to 2021. So exits are still a little slow. And as a result, I think partially because exits are still slow, fundraising is down. So 21, 22 in particular were very, very, tremendous years for fundraising. And then that's come down. And this year, it looks like it's going to be the lowest amount of venture capital funds raised since probably 2017. We will see. So that's sort of some facts. And now where do we go from here? So what I'd like to do is ask each of the panelists to briefly introduce themselves and tell us what their funds do. And you want to pay attention to what people say because over time, we've had some really good recommendations. Such a couple of years ago said to buy crypto, and that's been very good advice. Mar, for the last couple of years, has been super focused on generative AI, which was probably a signal to buy NVIDIA, which has done very well. And Jay, this is his first year, so he's going to have to establish his track record. So why don't we start? Mar, you want to tell us what Pear does and who you are?
Great to be here, Steve. Thank you for inviting me one more year, and great to see you again, Sach, and nice to meet you, Jai. My name is Mar. I'm one of the partners at Pair VC. We're one of the premier pre-seed and seed funds. We're based primarily in the Silicon Valley, even though we have some investments in New York. I think this may come up later in the panel. We are a generalist fund, meaning that we invest in all sorts of verticals. I like to say that we invest in anything that could make money, which sounds really simple, but people forget sometimes. For the last 3 years, the majority of the companies or the founders that show up at Pair are doing something related to generative AI, independent of the vertical or the part of the stack that they're in. So I feel we're at the frontier of what's happening. I do a lot of work in universities. I teach at Stanford, at Carnegie Mellon, and I see a lot of the new research. So anyways, excited to be here.
Very good. Sach.
Yeah, thanks for having me again. I'm surprised based on my predictions whether I was going to get invited or not. I just a little on Jump. I'm an ex-operator, started Jump about 15 years ago. We're investing out of our seventh fund. It's a $350 million fund. But what you'll find with this group today, I think, is a good stacking of the different stages of investment. We're an early stage investment, but we are typically investing in that seed and Series A stage, typically writing $4 to $15 million investments. We invest in three main categories. About a third of our fund, if not half of our fund, is infrastructure, cybersecurity, AI before it was cool. A third of our fund is fintech, anything in capital markets or compliance technologies and consumer based. And then the rest of the remainder is in traditional B2B SaaS. I'm based in Chicago. About a third or so of my team's in our New York office, but we invest almost anywhere. A lot of investments in Israel, London, but mostly in the US.
Cool. Jay?
Yeah, hi everybody. I'm Jay Das. I'm the co-founder and president at Sapphire Ventures, and was also Steve's student a long time ago. So I'm an alum of Booth School of Business. So we are a little different. Like we are more towards the later stage. So we call ourselves early venture growth firm. So we invest mostly in enterprise software, but in companies that have found product market fit. So our investment is really comes in to help them scale up their go-to-market function usually. So what that means is we typically invest Series B onwards, anywhere from Series B to Series C, D, even pre-IPO rounds. And we currently manage about 11 billion and investing out of a $2 billion fund. And most of the time we are focused mostly on companies selling to enterprises, so really enterprise software, but that can also be fintech infrastructure, software, but everything now, and of course now everything is mostly generative AI that we are investing in.
And do you have a sports thing too?
Yes, well, they spun out. So we
okay.
had a fund that was earlier stage that invested in sports media and technology, and that just recently spun out and became independent. They didn't want to be under the umbrella of an RIA, which we are. So that was hard to be an early stage fund and still be an RIA.
Very interesting. Well, it's always I like to say the good thing about getting older is your former students get more successful. So Jay is a good example of that. Okay. How do I was showing or saying VC is, there are some positives, some negatives, it's somewhat volatile. How do you assess the situation for venture capital now? Are we at about to go up, about to go down? Where do you think we are? And I'll start with Sach.
Yeah, so I always get this question about whether we're in a bubble. Where do you think that we're in a cycle? And I would say there has been very few times in my career that you get more excited about what is being built. So from a fundamental perspective, what the transformations that can occur, the excitement about what's actually being done has never been more interesting. And I've been an operator when I was in the first bubble and through the last 20 plus years. So I would say that that part of it is exciting. I would say the hesitation in my comment would be more about valuation. And I would say the enthusiasm is clear. I think the market has changed. A lot of your charts kind of depict it, but I would summarize by saying the people that were hanging out in venture in the last like 4 years have disappeared. And so the people that are there in the venture world are more astute, more aggressive, and leveraging data to kind of make decisions. And so we see good from great separate really quickly. And so we're running at the great, and we all are running at great. And so when you have supply demand imbalances like that, usually valuations kind of follow at the early stage, at least. I'm not a public markets guy, so I can't reflect on that, but I would say that certainly what we're seeing is valuations outpacing performance. And again, a lot of promise. Or our hope is, of course, they match up. The question is when.
Oh, so interesting. What are you seeing, Mar?
Well, I would say that there's a lot of maybe in the last few weeks, the voices of people saying, "Are we in a bubble?" have increased. A lot of people are asking me, like I am the expert and have the answer. But the reality is that we're not seeing it in the rounds that are happening. I do a lot of seed investments that are smaller, and the median seed valuations have continued to go up dramatically since 2013, which is when Pear started. They've more than 3-4x, so it's crazy, and they are larger than they were in 2021. That's just the median. I think what they don't take into account is the top decile or top 5% of seed investments that are happening, and those are done at very speculative valuations. A lot of it is FOMO, but they're happening at 100 million plus valuations, even billion plus valuations.
Seed rounds. Wow.
Yes. I think there was a recent article on the information about the Neo Labs, which I think is interesting to read because it has all the kind of born unicorns. You don't even have to grow into being a unicorn. You are born a unicorn by your seed fund. So those are real. These rounds are happening. They're competitive, and they exist. I don't know how many of those companies will be long-term, success, but that is happening for sure. So I don't see it at my stage, even at the seed round. Is still very, very high.
So both of you are saying early is still the valuations are high. So whether that is a bubble or not, it's
I mean, I think you can be either way. I can make both arguments. I think there was recently published a company called Unconventional, which the CTO of Databricks goes to start is amazing. They raised $1 billion at $5 billion. And this company will not have revenue for 5 years. They have to go and build servers and replace NVIDIA. God. So, but NVIDIA has this $4 trillion plus valuation. So maybe the payoff is worth it. That's the math people are doing. At seed.
Well, at seed, no. Now Jay's later. So Jay, what are you like even paying higher now, or what?
For sure. Well, I have a new term now. Like during the dot-com bubble, it used to be valuation based on eyeballs. Now it's valuation based off how many DeepMind engineers you have. So each DeepMind engineer is worth $1 billion. So get 10 of them, you're going to get a $10 billion valuation. Look, yes, it is a bubble, but unfortunately, the way that we have seen previously in these bubble times, also there are like ginormous companies are created, right? You go back and you'll see Google came out of the dot-com bust. So in the same thing, we already have two companies that are outpacing everybody, right? Like look at OpenAI. Like the incredible growth that it has, like it has become an incumbent literally in 4 years, right? Like now, like there is nobody to compete almost to compete against them, and this has never happened before in tech history. Similarly, Anthropic, right? So I think you have two probably $1 trillion IPOs going to happen from those two in the next, I don't know, 12 to 18, maybe 24 months, which has never happened before. But and in the same vein, we are seeing companies that are going from 28 to 200 or 3 to 120 in 1 year. So the amount of adoption, like you look at Lovable and Replit, right? These are numbers that have been published that both of them have been talking about. These things have grown from literally 10 to 200 in a year, right? So the level of adoption, the level of usage of AI is also going through the roof. So yeah, so I think it's a bubble along with kind of these, great companies being formed at the same time. And yeah, we used to kind of joke like 100x ARR was the highest we would pay. And I just saw a company that was doing it at 1000x ARR. 4 million in ARR and getting done at 4 billion.
Wow. So how do
And
you,
it's better than some of the companies that Mar talked about where no revenues and getting done at 5 billion. So
I think there is like a tale of two cities. There's real revenue and real companies for sure. And there's a lot of FOMO, which causes this, kind of crazy things as well. So both are happening. This is not different from any innovation cycle where, people get, it's just normal, I would say. And we will see some super winners.
I think the
But
well,
one,
it was
Cisco.
certainly true in the late 90s, right? You had some crazy ones and then but you had some real ones.
the one thing I would add that maybe gives kind of context, what we saw historically was deals that went from seed that go to Series A to B and B and beyond. There's typically like a 30% breakthrough rate. What you're seeing is that good to great or that tale of two cities, as Mar mentioned, separate. You're seeing that separation. You're seeing closer to like 1 out of 6 breakthrough. So if you kind of play that out to when Jay looks at it, he's really only looking at, a very small fraction of those C deals. So yes, the count
100%.
of them are higher. The ones that make it through to the next round are less. Our scrutiny and our bar is higher because we're all looking for that 4 to 100 kind of a ramp or ideal ramp. And when by the time Jay sees it, there's about, a lot of carnage that's on the streets from earlier rounds.
that's right.
I would totally agree with you that the pass-through rate from seed to Series A has continued to go down. And the bar for Series A, I think people the new names for companies are, the supernovas and shooting stars. And I think if you are, one of the top multi-stage firms, unless you are one of the shooting star companies with go from 0 to 3 million in the first year, 3 to 12 in the second year, they won't even open the door. So if you are, that other regular seed company, you are tier 2. It's just what it is. That's the world we live in.
And then Jay, you're going to look at those, but the valuations how do you get the valuations in a reasonable place or you don't?
It's hard. Some of it, like, we spend a lot of time because we see companies that, by the way, Mar, 3 to 12 is not where we would, some of my partners won't even look at it. It's like 3 to 20, right?
There you go. So if you want sapphire money, forget it.
3 to 12 used to be like the olden days. No, I still look at those, right? But we spend a lot of time trying to understand the durability of the revenues and the ARR. And it's sometimes hard to kind of tell, right? Like, what's going to happen over time and whether it's a good investment, meaning it's a long-term, what we call a company of consequence or a good trade, right? So in these cases, you end up passing on a lot of things, right? Like a good example, we passed on CoreWeave, so did a lot of other VCs. And Nvidia, Vishal, who runs Corp Dev, is kind of laughing because he got asked all the VCs to participate and nobody did because people thought it's a data center business, which it still is. But they have done a great job in executing and have a really great market cap, right? So we spend a lot of time debating this within our firm to really understand, hey, is this ARR that they are getting, is this durable or is it something because they have only been at it for less than 12 months, are all the customers going to churn away? And sometimes we miss really good deals because we don't believe that these revenues are durable. And so yeah, it's challenging to make these decisions. And then the valuation, when we look at it, Look, it's more of an auction. What we have learned over time that we passed on Databricks at 500 million. We passed we passed at Databricks at like 20 billion, right? And now it's like at a you would have still gone a 6x return. They're doing around at 130. So the how big these companies get is also has changed tremendously over time.
So that's
See,
a sort of broader question. Oh, sorry, go ahead, Mark.
I was going to say, I think like the power law of venture, which the exponent has become larger over time. So if it was whatever x squared, now it's x to the 20. There's a lot of death, and the ones that win so badly. It's amazing.
Yeah.
It's crazy. So I would
So
say
that's a general question. So does that mean that AI, I think a couple of years ago you said it's bigger than the Industrial Revolution. So is AI bigger than the Industrial Revolution, and how is it affecting like mature companies, or how is it affecting the world? And I don't know if you have any examples, but so that's two questions. Is it bigger than the Industrial Revolution, and what exactly is it doing?
Yeah, I would 100% agree that it's bigger than the Industrial Revolution.
Wow.
And the thing is that, if you go back in history and you look at, initially when a new platform, like when steam engines or something came along, people just modified what they knew well, and they just did it a little bit more with the new technology. And that's what's going on right now, right? Like we are just replacing something that we are used to doing in a traditional way with AI, and with AI-based products. I think the real innovation is yet to come on things that will be built on top of it. Just like Uber happened because of the GPS and the mobile phone, or DoorDash or Airbnb. Things like that are going to come up that we can't really say. Because right now, what everybody is doing is replacing things that, you can compose an email, or you can do like read a contract like a lawyer, all of these things that humans already do, but I think we are yet to see things that kind of make our life completely different because of this new technology.
Yeah, maybe on a more kind of broader level, I think I agree with Jay. I would layer in that much of the Industrial Revolution was its impact on how people thought about jobs, how they thought about what skills they needed. It really kind of transformed farmers into, workers and self-sustaining, and cities. I think we're in that level of transformation. That's why I'm super bullish on, skill development and reskilling. Thinking about, we were joking before this started. I have a kid in college. I have one that's applying to college as a senior. Like, are they going to come out with the same job that they walked in thinking they were going to get? The answer is, I don't know. And the answer is probably not. But I think that the premise that 5 years, 10 years down the road, does that transform what people think about from education, from a job perspective? And did AI transform that societal view? I think the answer is 100%. So it's got that level of impact, I think, across the board.
I would agree with my fellow panelist. I think it's also happening faster, and the economy is so much bigger than it was when the Industrial Revolution happened. So it's like in two axes, even bigger, But if you think about replacing kind of physical manual work versus replacing knowledge work, that's the level of revolution that we're talking about.
So I guess that's a question. What are you seeing in the labor market now? And there are probably two parts. There's the tech part, is hiring easier or harder than what's happening in the overall labor market and what's going to happen. So is it easy to hire? Let's do tech first. Can you hire people now, Mar, or are the people?
Well, I think again is the same thing, tale of two cities, and I think Jay said it right. Hiring these researchers is super hard. Look at Meta Super Intelligence, where they're giving packages that are up to $300 million over 4 years. Some of them
and those are real.
those are real.
Yeah.
Those are real. I have somebody who turned that down, but that's
real. We've had 5 seed founders be swallowed into that team.
Is that right? Wow.
Tens of
Wow.
millions of dollars
Wow.
for a person. I mean, it's happened. It is absolutely real. I think the other thing about that group in Meta that is really interesting, and maybe, a point is like, 90% are not naturalized Americans. They're like born outside of this country. So that's a big deal. Anyway, so that's happening. It's really hard. The other thing that's happening in hiring, one of our talent team members was telling me, I've seen the lowest response rate ever in my career, and they've been working for 20 years, is that, there's all these AI recruiting tools. So people are getting bombarded with emails every day.
Yeah.
Nobody's responding to anybody. So something has to change. At the same time, I think the junior folks it's real. They're having a harder time to find a position. You have to be able to do something else more than, what AI can do today to get one of those initial jobs. Anyways, that's what I'm seeing. Still very hard to hire.
I think the term I always use is this premise of flexibility and agility. And I joke because I have a chemical engineering and biology undergrad, and I'm not going to say I'm far from it, but I'm pretty far from it, right? And I do think that not even from an undergrad or a graduate school perspective, but like what you do, you have to have the flexibility and adaptability. So if you exclude the AI engineers, the researchers, the kernel engineers, people focused on, they're truly very unicorn type people that you're trying to find. Those 10x developers, that's a different market. So just put that in a separate bucket. The rest of the market, even traditional developers, there's traditional developers and there's ones that are leveraging technology to get more output to find that adaptability. And you're seeing that same thing in bankers. You're seeing that same thing in other roles. So I think that the short version I'd say is the ability to kind of be fluent in AI, the fluency in being able to kind of jump from a skill set perspective, even without the word AI, the phrase AI, I think is going to be the most critical. I will say for most functions, it's a buyer's market. Like most of my companies, when they're trying to hire outside of those kind of exclusions that I mentioned, they can go get who they want. Part of it is also if you're scaled or you have some stability, a lot of people are nervous about the market, generally speaking, and they're seeking some of that, from a risk tolerance level.
Yeah, look, I think everything is changing, right? I think the challenge is that business models are changing in every vertical. Like I think the whole legal field is going to get upside down with the way, it's people, lawyers make money and the whole structure. It's going to happen in our business, in venture and private equity. I don't think we'll need as many analysts and associates. So yeah, so the number of people you need is going to shrink dramatically, but you will need them in other spheres. I think the thing that I find that ultimately you still need people who can think, be analytical thinkers and be kind of entrepreneurial and also have great human skills, right? Human interaction skills. Because that ultimately doesn't go away, right? You still have to sell your product to somebody else, shake their hands, and get that thing done. You still have to motivate the people in your firm. So I think those skills become even more desirable and needed as we have more of AI penetrating into our workforce.
Yeah, maybe I can say a couple of things that we are seeing as well, even in at Pair. We've have a small engineering team and have adopted about a lot of generative AI internally to do work that before we had to do manually, like write the first pass at a deck, grade the quality of a team, etc. So the traditional role of an associate or an analyst that we may have had 10 years ago has changed from doing that to, being outside the office and getting to know people. So I think it makes the firm better in that sense. It's not that we're not going to hire the associate. It's just that they're going to be, we're going to need people like Jaya was saying that have a very high quality human interface. And I think, Stephen, you're in university, but I think those skills are more important than ever. Like, how do you present? How do you talk to people? How you take initiative? how do you sell, and those typically are not the things that folks teach in the MBA. I don't think we have a sales class.
No, it's what we did. It's one of the things we did in entrepreneurship, actually, like 10
Good,
years ago.
good.
We got on a selling course because it's like, it's a
That's
very
good. We
funny
don't have it
thing.
at Stanford, so I think
You
you guys
don't
are
have
figuring it out.
selling at Stanford?
No,
Because
we
it's like you
don't.
don't have a business unless you sell, right? And then it's
100%.
like,
I agree.
but the academics don't want to teach that, so we have practitioners teaching it.
Yes.
But it's
There
like
you go.
exactly. I think we'll get some academics at some point because you're right, it's very important.
I think
Yeah,
that has
no,
to
I
be
think learning how to sell, and we always say like, getting people aligned with your narrative, right? Because the best sellers are not pitch, they kind of have a narrative and they kind of have a vision and they get you aligned with that vision. Those are the best kind of people who can sell. And, that's not taught in colleges and business schools mostly.
Maybe to
No.
like even double click on this, if you look at the last 3 hires, I'm just reflecting in retrospect, this is not a formed comment. The 3 people on my team that just joined all came from sales engineering backgrounds, right? So yeah, technical chops on the under the hood, but very much are extroverts. And certainly, I would say if you rewound the clock, and I'm sure everybody on this call would say, is like usually it was an ex-investment banker. It was a very different type of profile that we oriented towards. So the extrovert is definitely that interpersonal skill is super important.
Yeah, the differentiation between people.
Very, very good to know. Okay, I'm gonna shift a little bit. Anything you'd avoid in tech?
Clearly not high valuations, right? That's not the answer.
No, look,
Avoid high valuations.
No,
Okay.
I think we see, and it's in our portfolio too. A lot of the old SaaS companies. I don't know how they get out of this, right? And if you're like a PE firm that has a whole slew of even older B2B SaaS companies, I don't know what happens to them, right? Some of them, the really good ones with good CEOs, have basically transformed the company by focusing on AI and how AI, like, basically uprooting the whole culture and the engineering team and the sales team. They are the ones who will survive and succeed. But there is a whole slew of B2B SaaS companies in the 100 million, 200 million that, I don't know what happens to them. And, we are definitely avoiding those.
Vulnerable. Yeah, I mean, maybe I'll add 2 comments. One is I know I have a lot of friends in PE and some of them are probably on this call, but I would say I'm very short on the PE industry. There are very few that are really actively thinking about AI in not a superficial way for their portfolio companies. And so I totally agree with Jay. There's so many people, so many companies being funded to disrupt those industries that they will just literally leapfrog some of those solutions. The one thing I would layer on is it is really hard to be an investor right now, I think, because the ability to understand where the traditional, kind of platforms like the open AIs and the like couldn't necessarily develop and enter is very difficult. Then you say the existing players, the Salesforces, the Microsofts, insert name of established distribution partners, how they can't build or extend where they're at and layer on AI capabilities. So you think about like these workflow automation tools that don't have network effects, don't have distribution advantages, don't have a data moat. I mean, what startup has a data moat from the onset? None. So it's a very difficult model to figure out where is that perfect kind of coalescence around being able to kind of navigate differentiation and then being able to scale in this market, I think.
Especially at seed, I would say. Listen, I think this is so interesting about the PE people because they're all freaking out. I think it's no surprise. They all know they are in a bad situation. So I think the most aggressive, like we've been I think a bunch of PE firms are knocking on our door. Like, what can we do? Like, do you have anything? Can we use it? There are new PE firms. One of my students started one a few years ago where they have hundreds of AI people and they're just like, kind of changing how you're doing these PE roll-ups. So I don't know. And a lot of venture firms, VC, Thrive, Bessemer, they're all doing all this hybrid PE VC roll-up. So it's very interesting.
Where they're buying, so they're buying like these run-of-the-mill not run-of-the-mill, but sort of
Yeah.
mundane
Yes,
companies.
Regular
and then-
businesses.
So
Hospitals.
can you give an example?
Yeah, they'll buy accounting firms and say, hey, we're gonna like use all our accounting AI agents, and we're gonna, if a traditional PE may improve your margins by, I don't know, whatever, 20%, they claim they could do it by 50 or 60%. I don't know if it's true. We don't
Yeah.
know,
So
but that is the bet.
yeah, there's a bunch of them. There's one around call centers that
There's
General
so many.
Catalyst did called Crescendo. There's one under lawyers, UDIA, which is basically doing this and bought law firms and is putting in kind of Harvey-like kind of features in it. There's one other company in the MSP space that has been doing. So yeah, so the it's going to be interesting to see whether you can do the roll up like from a just a theoretical perspective. It makes a lot of sense. Like, yes, I'm going to buy these companies with large distribution. I'm going to put in tech and then kind of get the gross margins from 20-30% up to 70-80%. Of course, the devil is in the detail. Like, can you change the culture? Can you actually put in those technology and slide it in and actually keep the business going? But the bunch of people are making those bets.
For sure. Anyways, and it's a blurry line. Like I said, I think the people doing venture now are doing this.
So the
Yeah, it's kind of an AI
and this is
AI
this is
inside out.
all of private equity. It's not just the software players. It's you think it's everything. So that means all companies.
Actually, every
Or
company
risk.
you could be software or tech enabled. Depends on how
Okay.
you
I would
want
say services and tech. I don't know if I would jump to manufacturing. I think they tend to be automation focused. There's a
Yeah.
lot of
It's more
adoption
CapEx,
you can layer in, but certainly if you're in the services sector as a private equity firm or a tech investor, and not very aggressively thinking about how you can transform, not just layer in AI, it'd be a very vulnerable spot.
Okay.
Stephen, just to maybe the areas that are hard to invest, I would tell you, like in the last couple of years, I think that has completely dried up is capital for climate tech. I think some companies are rebranding as we are not climate, we are American dynamism companies. So, if you can actually pull it, if you have a high human interface and can pull that off, some people are doing that, but that for sure is dried up.
So no climate. That's very interesting. The climate tech being things that would use technology to reduce our carbon footprint, huh?
Well, some of them are saying that, like, is investing in nuclear fusion, is that climate tech or not? Yes, it kind of,
Rebrand.
because I think that's one of the biggest bottlenecks right now with all the AI stuff is power. I
Yeah,
think
that's-
people don't realize that there are data centers in the Midwest that can't light up the servers because they have no access to power. And I think
And I think a year ago or 2 years ago, it might have been climate. Now this is American independence and, et cetera,
So
Yeah.
what about will fission drive these things? Are you seeing
I
fission
don't know. We
things?
don't look at that space, so I
You
don't
don't look
know.
at it, okay.
But the point is that even of those reactors won't come online for like 5, 6, 7 years. So
Right.
I think there is a good case to be made about all of these private credit going into all of these data center build outs will be stuck. And then of course uh, you know they can't put any of the servers because there is no power to actually run these servers.
Hmm. Okay, let me push a little bit more on the previous thing. So are there all these deals were done in 2021, maybe 22, both venture and buyout that were at high valuations, and a lot of them have not been exited. Are those going to be exited next year?
Look, people are doing cram down rounds. People are redoing valuations that have all started happening. Even people are going IPO at a valuation much lower than what their last round was done. So yeah, so I think people have kind of at this point are trying to find homes for most of these assets because and people are not work like people have realized that they're not going to get the same marks they got in 20 and 2021.
I think the
Yeah.
oh, go ahead, Mark, please.
No, go ahead, go ahead.
Yeah, I mean, the phrase that comes to mind is like rationalization. I think people in venture and founders have either rationalized a lower valuation, an appropriate valuation, and are willing to reset. They've either decided to close up or to exit. And I haven't seen a lot of that, to be clear. I've seen a lot more of what I would call haven't rationalized and are what I would term standing two drunks, right? You have two startups, let's combine them together, and maybe together with scale, we can get to the endpoint. We could debate whether that ends in the same manner or in a better manner. But I would say the core tenet here, those companies, these are pre-ChatGPT, pre-Gen AI companies. You really still need to either think about transforming yourself like that SaaS conversation we were just having, or somebody in private equity comes in and says, there's a roll-up strategy and there's an arbitrage to be had to roll up a bunch of these companies together and apply AI. So I haven't seen that yet. And I mean, frankly, we have a lot of companies in that era that are still trying to transform themselves before going out to market.
So it's not
Yeah.
not happening yet. Okay.
I think Carta put some data out where, I think 60% of the unicorns of 2022 have had no financing since then. And, maybe 20%, half of it up, half of it down. So I think there's still a lot, those companies had a lot of money, a lot of people adjusted their burn, and, that at some point they have to exit and people have to be okay with the
Right.
fact they might not be a unicorn, right?
No, that's the
So
question
it's
is
going to
when
it's going to happen. I don't know if it happens all next year, but it will, gradually happen. And I think
Or they can just live on as zombies, right?
zombies
well, that's the question, right? Whether
or
they're
zombies.
zombies or not.
But people eventually have to, close for LPs, people
Yes.
eventually have to do something.
Okay, how about I'll move to blockchain and crypto. What are we seeing there? I know you all have something in blockchain or crypto, no?
Yeah.
I think all three of us do. We're probably a little abnormal, this group, because we all have interest and have invested in the space. I wouldn't say that's common in venture.
Mm-hmm.
There are certainly crypto native venture funds. We had in our current fund, a separate dedicated vehicle for, in high scale, 9 figures. I would say that my general comment is like the new administration has totally opened up the market, right? Has really given this kind of reprieve for traditional players to enter, whether it's forming ETFs, applying or adopting blockchain. It's a risk aperture. They're willing to do that they weren't because they weren't sure what the regulations were or the willingness to oversight. I will say the adoption's still early, right? I mean, it's still an early vehicle. You're not seeing many tangible use cases for the mainstream. It's very much a tradable asset. My dad owns it. I mean, obviously, it's a little bug on the CNBC ticker, right? So, like, when my dad owns it, like, that it's actually a tradable asset. But I would say, generally speaking, the things that we get excited about are stablecoin. And a lot of that is more because it's like a gateway drug to crypto, really, because it has a lot of traditional use cases. And is a little bit more tangible because it doesn't have that same volatility since it's pegged typically to the US dollar. But yeah, like still very excited about the space, but it's still got a ways to go from an adoption perspective.
Yeah, I'll say that stablecoin is definitely the first use case that has just taken off. Like, I have one company that is basically payment rails based on stablecoin is just ripping. How much people are using stablecoin because it makes the whole financial kind of transfer of money so much more efficient, right? Like Visa at this point keeps like 80 billion of float and they get my interest on that. There's no reason why Visa should be holding 80 billion of somebody else's money on their balance sheet. And it doesn't transact over the weekend, right? If you are a merchant, you're not going to get paid over the weekend. In this day and age, it makes no sense. So I do think stable coins as a platform for money transfer, payment flows is here. And there's lots of use cases that you can build on top of on stable coins. Blockchain, it is slower to adopt, but we had the company SoFi and one other company that went out that is based on, mortgages and everything based on blockchain. And I think it's going to happen, right? But there's more institutional kind of apathy, or or even like headwinds from institutions from adopting these new technologies. But all of our crypto, like a company called Blockdaemon that provides a lot of infrastructure, they are talking to every fintech, JP Morgan, Citibank, Goldman, they're all looking at crypto using blockchain to make all of their infrastructure much, much more efficient.
Okay. Let me, I'm going to move to geography, and then I think we're going to probably run out of time, or I'll have some questions at the end. This is a Chicago audience. So how is Chicago doing now? And, is it New York? Is it San Francisco? Is it Chicago? Is it, Texas and Florida? What are you seeing in terms of geographies? Mar, why don't you start?
Well,
You're in many
not,
geographies.
I am not in Chicago. So we only work in San Francisco and New York. I do think obviously San Francisco was dying 3 years ago, and now it's kind of the center of the universe again due to the AI activity around here. I think New York is grown. The startup scene there has grown dramatically. I love New York because people go there to make money. So there's that, kind of willingness to make it, same as here in the Valley. And a lot of folks, even that start here or go there. So I don't know much about Chicago. I don't have any companies there, so I'm very sorry, Stephen.
It's okay. Let's try. Maybe Jay will do better, and then Sach is here, so he'll do the best. But Jay,
No, like when I look at our portfolio, 20% of our portfolio now is in New York, and 40% of our pipeline is in New York. And yeah, and then the rest, most of it is in, on the West Coast, Seattle, and of course Bay Area, and then a little bit in Seattle. And the reason I think why New York has the three things. First and foremost, there's an ecosystem that formed with all of these companies that went public, right? Datadog, Mongo, I forget, I think there's a bunch of other consumer tech companies, fintech companies. So that's number one. Number two, you have custom. Before, the most of the industries in New York, all the financial services would not talk to startups. But now they are like all talking to startups immediately. They all have innovation. They come to the Bay Area, right, to talk to startups. They are actually have POCs. They have budgets with all these startups. So the startups can actually be there and find customers to sell to. And the third thing that has happened is that, entrepreneurs, mostly from Europe and Israel, because of time zones, they don't want to move to the Bay Area, right? The time zones are much closer for them because they have teams, right? Teams in Europe, they have teams like in Israel. So it's a lot convenient for them to be kind of in New York. So yeah, so New York has definitely, and I think to what Mar said, that there is an attractiveness to be in a big city where everybody's focused on kind of building businesses and getting compensated for that. So it's the startup scene is definitely very hot in New York.
Interesting. Sach,
Yeah.
you have anything good
Yeah,
to say
the
about?
only incremental thing, I mean, so this is a trend that I think the last two of these sessions, Mar, Antonio, and I kind of said the same, that New York is definitely where you're seeing the young talent want to go. That's only accelerated. That's the one thing I'd say. SF certainly has been beneficiary recently, but a third of my team is now in New York, and that alone is a novelty. That was not the case a year and a half ago. That's both because they want to live there, where our deal flow, it's very similar to Jay's. We also do a lot in Israel, so it's an easier vantage point for them to come here and vice versa. I would say that one other thing about Chicago, I mean, one is we have a lot of late stage companies and we have a lot of really early stage companies, and there's a real gap in the middle. So I would say 22, 23, 24, I just didn't see that much that got funded, nor that was showing up at our doorstep. Obviously, I'm based in Chicago, so I'd love to do more Chicago deals. We're under 3 term sheets right now. And I would say one of them is Chicago, so we're pretty excited about that. But that person also built its roots, its product DNA from SF. And that I think is the key thing, which is we're seeing a lagging on efficient product build for efficient GTM go to market on sales in Chicago. Their knowledge of market, their knowledge of industry, their access to customers, nobody debates that. So hopefully we'll see a little bit more of that adapt. And again, it's that risk tolerance that you see in the Midwest that I think is starting. It's not as consistent, the willingness to take that risk. When you do see it in Chicago, you see some really great successes, but it's not as consistent, I'd say.
It's more in the Bay Area in New York.
Mhm.
Okay, that's well, that's interesting to hear. Okay, last question, and then you're going to do some predictions. What worries you most in the next year? Jay?
I actually worry about the whole private credit stuff that can kind of burst the
Okay.
bubble a little bit because, just like there was mortgage-based securities, now it's NVIDIA-backed securities, right? And if there is thankfully, NVIDIA had a great quarter that they announced yesterday, but everything is tied together, kind of, and all flows back to NVIDIA hitting their number, then OpenAI getting to like 300 billion by 2030, right? And if there's any hiccup because of power or because of this, that whole thing can come crashing down.
I would totally agree with this, that, I think everybody was breathing yesterday.
Yes.
But yeah, it's like NVIDIA and OpenAI, if they miss their numbers, it's gonna hurt everybody. And we don't know the impact of it. There's so much debt on those data centers.
Interesting.
And you're seeing the market down. So obviously it was a short felt, kind of
Yeah.
blip.
No,
I
the
would say
sentiment is there.
that was exactly where I used exact word I was going to use, which was like, I think the headlines are driving the sentiment and
Totally.
there's a nervousness in the market for sure. And I'm nervous about the CFO's impact because the CFO controls the budgets right now for software, which is what most of our dollars are spending on. And so when public companies have more scrutiny, they get slapped for taking risk, right? And when the market sentiment is negative, if you're taking risk, so the pullback will come from sentiment changes, and that makes me nervous. So the more we talk about bubbles, the more it's not even realized, but it's just talking about it, it would pause or slow spend, and that's always the concern for me.
Okay. Very good. Okay, now predictions. I've got 5 questions, and then we'll see what happens. So number 1, will IPOs be up, flat, or down in the next year? Mar?
I'm gonna say up.
Up? Such?
It's definitely up.
Up. Oh, wow. Jay?
Yeah, it's up.
Okay, so bullish there. Dollars invested in VC. Jay?
I think it will, there's still plenty of capital there. So I would say it stays about the same as this.
Flat. Okay. Such?
Yep, steady, flat.
Flat. Mar?
Well, I'm gonna say a little up because it's just the lowest it's been for this year. It's not gonna be one of the lowest. So,
Okay, here, will NVIDIA be higher or lower next time this year? Who's gonna go first?
I'll go. I think, it higher because, otherwise we'll be talking about a whole bubble collapsing next year.
Yeah, since we answered that the IPOs are going up, that does NVIDIA is still up.
You're gonna be up, and
I think we're in a slinky economy. I say steady. I think
steady.
flat.
I'll take down on NVIDIA. Bitcoin higher or lower next year?
From where it is today, from
Yeah.
80, it's at 86.
90, where
I
does
just looked it up.
90,000? Or where is it? 86 now?
86.
86. Okay.
Yeah, I say up.
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 Okay. Well, very good. So largely consensus, not completely. So that is terrific. We are now at 1 o'clock. So I am going to thank our panelists for another fun and insightful hour. And thank you all who joined us, and hopefully see you all soon, if not next year.
Awesome. Thank you so much. Good to see everybody.
Thanks, Steve.
Thanks, Steve. Bye now.
Bye-bye.